Hey guys, it's Imran from Options Insight with your macro options spotlight for today. Now, before we jump in, if you like these videos and you like this type of content, please like and subscribe to the channel. That will really help us with the algorithm and get more people to see this type of options related content, and it will really help us grow. Okay, what a day in markets. Brutal. Markets continuing to sell off, obviously starting on the back foot. After the market digesting FOMC, the hawkish message from Powell, China coming in with poor data, and just throughout the day it got worse and worse. The selling continued. ECB also triggered more selling as they came out more hawkish than expected. And then European markets really joined the selling, and they haven't really been doing that of late, and finishing the day down with 3 sigma down moves, as you can see here, with both DAX and Eurostoxx down more than 3%. The VIX also popping up around 8% there, back to above 22. It tried to come off, obviously, post FOMC with the typical vol reset that we tend to get after events, but it didn't manage to stay down for very long as markets slid. The S&P kind of shaking off those pins that we were thinking were for expiry today, 3950 and 4000 areas where the primary concentration of open interest was. And as we broke down below that 3900, you can see now even overnight futures kind of chopping around even lower, down near 3850. So those pins are kind of history now. It doesn't look like they're in play anymore. And really the excuse that I'm hearing in the market for this relentless selling is CTA selling. And we'll talk a bit more about that in a bit. Commodities also sank. Only natural gas finishing in the green on the day, up 7.5%. Everything else was down pretty hard. GDX, silver taking 3 to 4% beatings, and copper also down 3%. Looking at vols did recover. You see you see equity vols up about a vol point across the board there with Europe and US. Now, to be fair, you would expect on a 3 sigma sell-off, vols to actually be up a bit more than that. But obviously, it just goes to show that had markets not sold off, vols probably would have been down. And the fact that we got that big move is what made that down move reverse, and they finished up on the day. Asian vols were still softer, with China and Nikkei coming off. Nifty, however, was a bit firmer, up a vol and a half there. Commodities vols kind of mixed up and down, nothing really clear to say there. If we look at the carry side of things, that positive carry got eviscerated in Europe. It had been about 30 to 60% positive carry in Europe. One big down day like that has just wiped it out and turned it negative. So it just goes to show that these carry numbers, you can't hang your hat on them necessarily too much, because one big day can kind of change the picture quite dramatically. Now, where we still do see positive carry is in FTSE and China, FTSE and Asia, sorry. So that's still in green. But given what markets are doing, given that the macro markets are kind of under a bit of pressure right now, and liquidity is evaporating, whilst we did think that we're going to get some stability post OPEX, with markets down here, certainly in equities, that stability might be hard to come by. So remains to be seen how, if we get follow through today, and then how things look on Monday or Tuesday, and if the bulk of the selling does get done and markets can stabilize. But certainly markets down here are looking a bit more fragile than they were a couple of days ago when we were closer to 4,000. If you look at skew, it did recover on the sell-off, led by the DAX, which was up over a vol point in terms of that 25 delta risky. Gold skew also bid, flipping back towards positive where it was negative. So puts kind of going back towards premium. Same thing on copper. Big spike in copper skew there, 1 3/4 vols. That was for calls only yesterday, and it has flipped back aggressively towards the put side as things sell off. And then finally, oil and oil skew coming in there, down another vol point, down to 1.5. So that's looking relatively low oil skew. Maybe people still favoring some upside in oil, bidding for calls. Because spot price has been relatively resilient in oil as well. Okay, moving on. The thing that's really driving the weakness, right? So obviously after the FOMC, we did get the vol reset lower. Options traders started to price in a quieter period into year end. That's typical. Now the events have passed. Yesterday's relentless selling, though, has put an end to that. Okay, so we thought we were going to stay pinned somewhere between 3950 and 4,000 after the FOMC. That's what the price action looked like. But as we as we saw, we continue to just relentlessly break down. And when you see that price action, that looks like program selling. It looks like someone is just liquidating or program selling over the day, because markets just don't find any bid and don't have any real bounce throughout the day. So now what we've heard from the likes of Nomura and GS, who track this stuff pretty closely, is that CTAs, who are these momentum-driven funds who are systematic in nature, their momentum signals have shifted down. So the idea was that if we did get a 2 sigma down move in markets, which we clearly got yesterday, then the amount of selling that we would expect to see over the coming days and week would be in the 130 billion kind of range, which is pretty big and probably bigger than the market can absorb without materially selling off, right? So what we're seeing there, liquidity has been evaporating. You can see top of book liquidity in the S&P is pretty poor. That's what this graph is showing here. And then this graph is showing just how much selling there was to be done by CTAs if the market was to roll over, and it certainly has rolled over. So it looks like traders are now front running that a bit with the sell-off overnight, everyone hearing about this CTA selling story and trying to push it even lower. So we may get a bit of chop given that expiry actually is today, and there's $4 trillion worth of options notional rolling off on quad witching, as they call it. But in general, if the CTAs have got a load of delta to get out the door and they're doing it at a time where liquidity isn't very good, then there tends to be more market impact. So I'd be very careful about running big delta positions right now in the face of this potential selling flow that needs to get absorbed and potentially isn't quite finished yet. Okay, so that's what's been going on. Looking elsewhere, Euro. So I said ECB was very hawkish. So now it's been becoming clear in recent months that as the Fed is slowing down their tightening, and they've been signaling that the ECB still had a lot of work to do, right? Inflation stubbornly high in the Eurozone. The European gas crisis meant that the economy didn't roll over quite as badly as we thought yet. And therefore, their storage tanks have been quite high. That's what this graph is showing here. So they've managed to get through this winter okay. And these factors have been generally making euro quite well bid. So you can see the green line on the chart is euro dollar. It bottomed out at 96 a couple of months back, and it got up to about 107 yesterday at the highs. So a decent rally there. Now you can see the yellow line is the Bund BTP spread, and it's inverted. So when that's going up, it means the Bund BTP spread is going down, and when this line is dropping, it means it's blowing back out again. And you can see generally they've tracked each other pretty well for the last couple of months, okay, last few months. Now you can see recently, yesterday, we saw Bund BTPs go higher from about 185 to 220 basis points. So that's where it's gone to. Whereas Euro's done not a lot. It's actually gone higher on the kind of hawkish message. So this divergence doesn't tend to happen for very long. And we do think that if Bund BTPs continue to widen and get back to the sort of 250 level, which is kind of the extremes that we've seen at various points in this year, we think euro dollar is going to struggle with that and is probably going to sell off. So there's definitely this divergence that's here. If Bund BTPs compress back down again, the euro can hold its levels. But if you've got to watch this, if BTPs continue to sell off more aggressively than Bunds, then I think it's going to be hard for euro to rally. So how would we play that? Commodity performance clearly has been decent year to date. It's been driven primarily by the energy sector, which is up over 40%. Okay, grains are also up, but then the commodity index is up about 15% on the year. Now, the nice thing about commodities is they give you inflation protection. Okay, so the idea is, as we've had inflation this year, 60-40 portfolios have got crushed, bonds and equity have got crushed. If you've been in cash, you haven't lost as much money, but in real terms, you still lost money because inflation is so high. So the purchasing power of your money has dropped in cash. So commodities have kind of been the only place where you've earned a positive real return. And this is similar to the type of stuff that we saw in the 70s when we had rampant inflation. Commodities was the place where you had to park yourself. Now, the nice thing about owning commodities and owning it via things like ETFs that use futures to get you passive exposure, and they continuously roll those futures, is that we've been in backwardation. And backwardation in the futures curve is a condition that typically exists when when physical markets in commodities are tight and you get this backwardation. And that makes it quite a nice condition for passive rolling strategies in ETFs to own commodities. And we can see that the commodity ETF, an example of a broad commodity ETF, is this CMOD. And this is basically listed, I think it's listed in the UK, and this is up 15% on the year. versus the underlying index only being up 8%, the equivalent. So basically what we're saying is that roll yield of backwardation has earned you an extra 7% return in your passive long commodity exposure. And that's because of this physical tight condition that is keeping a backwardation in the curve. Now, those curves have started to reduce in backwardation. Oil's even gone into contango in the super front end of the curve. So that's not necessarily as attractive right here, right now. But if we think that due to the lack of capital investment in the commodity market, in the space to pull more commodities out of the ground, and certainly in the energy sector where there's no incentive to increase supply, we think that backwardation probably persists next year. And if it does, then commodities offer you quite an interesting proposition, because not only do they provide you inflation protection, if you think we get structurally higher inflation over the long term, you also have a yield, right? Whereas people are saying bonds now give you a yield, bond gives you 4% or whatever. This thing gave you 7% yield this year, and it could potentially still give you 3 to 5% yield next year if things stay in backwardation. And on top of yield, unlike bonds, which will get killed in an inflationary world, in theory, this will do really well in inflation, because that's the whole point of owning hard assets and owning real assets. So I think it's an interesting story. I've been long commodities in my long-term portfolio all year, not just all year. I think I bought them in 2021. I'm a big advocate of having some of that in the book. And this just kind of gives you further evidence as to some of the benefits and why they've worked so well this year. And they probably will work quite well next year. All right, that's it for today. And it's been a roller coaster of a week, but hopefully you've survived it. It's been a tough one. And I don't think it's about to get any easier given what markets are doing. But anyway, have a good weekend, and I will catch you all next week.